We're all familiar with the old idiom, as safe as houses. It alludes to the idea of property being a solid, risk-free investment opportunity. And indeed, history's shown that when it comes to the long-term investment, property is a pretty safe bet. As accountants, we're often asked by clients whether it's better to use a property investment company or own a property personally. Let's take a quick look at the basic differences. When you buy a property personally, the deeds are in your name, the mortgage is in your name, and you personally pay income tax on profits generated by that property. If you buy through a property investment company, it's the company that buys the property. The mortgages are in the company's name, and the company pays corporation tax on any profit. These property investment companies are also known as SPVs, or Special Purpose Vehicles. They're set up for the sole purpose of purchasing and managing buy-to-let property, and they're becoming more and more common. Last year, over 3,000 such companies were established, and nearly half of all the buy-to-let mortgages were issued to property investment companies. So it's clear that SPVs are an increasingly popular choice. But how do you know if they're the best option for you? In the past, higher rate taxpayers were able to claim mortgage interest payments as an expense, therefore reducing their tax bill. But since 2017, this form of relief has been phased out. This change has really hit people who own their properties personally, particularly if you're a higher rate or additional rate taxpayer. If the property is owned through an SPV, your rental properties will be subject to corporation tax, which is currently 19%. Also, you can offset any financial expenses that relate to the business, so this can really reduce your tax bill. Another big positive for the SPV argument is that you can reduce inheritance tax. This is because within an SPV, the property can be sold or transferred by selling, transferring ownership of the company, and as a result, very useful in terms of legacy planning. There is a note of caution, however. If you already own the property privately and wish to transfer the asset to an SPV, there will be capital gains tax to consider and stamp duty to pay. So any decision around personal or limited company ownership ideally should be made at the outset. Equally, when setting up an SPV, there's an additional administrative work involved, including filing year-end accounts with Companies House. So there's much to consider. It's clear that SPVs are a complex subject. There are pros and cons of each scenario depending on each landlord's financial and legal objectives. As accountants, it's our role to help investors understand and assess those options. So if you're considering investing in property, we can construct a financial model that compares each approach for your situation. Let's make your business as safe as houses. Please get in touch so that we can help you make brilliant business decisions.